It's generally best to remain committed to your investment plan. And we've talked about this before on the show. Rather than reacting impulsively to headlines or short-term news, as much as that headline shock can hurt, while it can be tempting to try predict market movements for the intellectual challenge, let's call it that, focusing on a consistent, disciplined approach, that's really where your results are going to be better in the long term. We highlighted this actually in a recent note at Q Wealth to our clients. We talked about maintaining a steady approach and that being more valuable than relying on opinions or forecasts. Although geopolitical shocks can cause quick fluctuations, we can see a lot of red on the screen if we're looking at markets. History demonstrates that markets often bounce back strongly during uncertain times. Our deputy chief investment officer at Q Wealth, he examined some data. And if you go back to 1950, an investment of $1 in the S&P 500, so essentially the 500 largest publicly traded companies in the United States, that $1 has grown to 413 as of March of this year. If you held steady, though, that's the key thing. If you missed the 50 best days in the market, your $1 that had grown to 413, well, now that $1 only grew to $29
Hmm.
if you missed the 50 best days. And even worse, Brent, if you missed the 100 best days, your $1 only grew to $5. So really what this is underscoring, this simple little data set, is how vital it is to stay invested. As you might be tempted to time the market, to try deal with these headlines and work around them. But if you're going to miss the opportunities of those best days, thinking that you're getting out on the worst, timing in and timing out, it's a really challenging game to play.
And you've mentioned, Andrew, on the show before that diversification is the closest thing to a free lunch in investing. So it's probably essential to stay diversified, keep invested and diversified.
Exactly. It's diversification is you're right. It's the closest thing to free lunch we have in the investing world. It's how you prepare without pretending that you can predict. Our message has always been that portfolios should be built to absorb uncertainty. So you're not going to avoid it entirely. And right now, clients are feeling that, right? If you're looking at the markets and you're seeing the volatility of the last few weeks, but diversification across regions, sectors, asset classes, business models. No single event or narrative is going to determine the entire outcome for everything. So we saw this in 2025 when international positions, which previously had been laggards in diversified portfolios, they began to perform well again, along with small and mid-cap companies, as well as some different asset classes. After long periods where it was really just the US stock market that was leading the capital markets. So no one can consistently predict which market or sector will lead next. So a resilient plan should not rely on getting that call exactly right.